Hi guys, and welcome to episode 1 of the KWM Show with Keenan Wealth Management. I'm your host, Peter Keenan, Principal Partner at Keenan Wealth Management. Today we'll be talking mortgages, one of the biggest issues facing the UK public going into 2022. In the first 6 months of 2021, I've received more mortgage inquiries than ever before. Mortgages can be a minefield, and finding a trusted advisor who's qualified and professional is imperative, which coincidentally brings me on nicely to our guest, Kenneth Murphy of Kenneth Murphy Wealth Management. Welcome to the KWM Show, Kenneth.
Thanks very much for having me. It's a pleasure.
Nice to see you. How are you?
Oh, I'm good. But like you said, busy, which is great.
Good.
Everybody and their dog is looking for a new home. And I love helping. Excuse me.
More than welcome to the show. Happy to have you. And like you said, mortgages are huge at the moment. So give us a brief introduction to your business, yourself, and how it came to pass that we started working together.
Absolutely. So, for me, background of myself, I have been now doing my own self-employed company, Kenneth Murphy Wealth Management, for the past 3 years. And prior to that, I was the bank manager. So being a bank manager, I was there for 13 years, so very familiar with mortgages. So when I became a financial advisor, it kind of made sense to also get my mortgage brokerage license because I was so familiar with them and understood them. So going forward with that, then I was able to invite a lot of people over that I knew from the banking who were able to, help with mortgages. And the stages of mortgages, I think the most important thing for people, why you would want to get a mortgage broker, I think, is one, you need to find somebody that you know, like, and trust. And usually getting a referral off somebody is the best thing. So you can meet somebody. But you want to know, why would somebody go see a broker? That's what you asked.
Yeah, we've got quite a bit to cover today.
Yeah.
We've got an agenda that we've set out. So we'll just get straight into it just now. What does the mortgage process look like, start to finish? How does it work? And what can you offer that a bank, for example, can't?
Yeah. Well, mortgage process, it's pretty simple. If you're buying a property and you need a mortgage, you've got a deposit, get a mortgage. But the difference between having a broker and having going to your bank. So if you go to a branch, and there's some great mortgage advisors who work in branches. I've worked with them, fantastic people. But when you're getting a mortgage company is making a decision based on you and your circumstances. And they're also making a decision based on the property and what the property is like. And every mortgage company has different criteria.
Yeah.
Okay. So if you are, and everybody's circumstances are a little bit different. So if you're going to the branch, they can only offer you the mortgages based on their terms, their mortgage products and their criteria. So you can potentially not get the best deal, but they may not be able to lend based on either the property criteria or your own personal circumstances. So, but a mortgage broker will have access to the market, and which I've got access to. And as well, a mortgage broker will be very familiar with the criteria that mortgage providers need.
Yes.
So, if somebody came to me with a particular circumstance, if I wasn't aware, I've got all the tools and information to find which company will lend based on that. But in general, I probably know straight away what somebody might want. If somebody wants maximum borrowing capacity, I know the company's multipliers on incomes, where I would probably start the search at if somebody really wanted to maximize, they've found a property that they like and it's going to be a bit of a stretch. So it's understanding that, and it's the experience that you get with a mortgage broker that can make a difference. But again, as well, if you find a good mortgage broker, you've got them for life.
Yes.
And particularly if they are self-employed or if they have their own company, etc. Because if you go to a branch, again, it is just that one bank's products that you've got. So you're not necessarily getting the best product on the market. But also you will meet a lovely mortgage advisor, but it's probably likely that they won't be there when your mortgage comes up for renewal again.
Yeah.
You know?
Yeah.
And it's great to have that relationship. And in this fast-paced world we're now living in, you know, when you give your information to me, I've got it. It's stored securely here in St. James's Place,
Yep.
but it is also, you don't need to repeat yourself. We will update it, but at least once I've got it, I know you and I know what your plans are, and I'm able to find a mortgage that's suitable.
I think you made a good point there. We've both worked in banks before.
Yeah.
And like you said, some of the mortgage advisors that work in bank branches or telephony centres are incredibly good at their job.
Yeah.
But they are tied to that specific bank. And they tend not to hang around too long. So especially in branch, I've seen it myself in a previous life.
Yeah.
Mortgage advisors in a branch will maybe hang around for a year, 2 years, 3 years max, and then they will move to a different branch or a different bank.
Yeah.
Or they may decide to go self-employed themselves.
Yeah.
So the main difference, I guess, having a broker like yourself is, as you said, once you're a client, that's your client for the rest of your mortgage life.
Yeah.
Whether that's remortgages, home moves,
yeah,
you know, renovations, refurbishments, whatever that might look like.
Exactly. And somebody can phone my mobile, you know, and get in touch and ask questions. And the good thing as well, with me being their mortgage broker, I'm a fully qualified financial advisor. So I can, you know, give them hints and tips and help them in other areas as well. So, and I understand their financial plan and know what their goals are. So it makes a big difference. And having that relationship is really, really good. You know, my clients, you know, they're stuck with me for life, whether they like it or not, which is why I say, get somebody you know, like, and trust, you know, because you want that. You want to be able to move forward. I let my clients know, because a lot of mortgages, you're on a 2-year fixed or a 3-year fixed or 5-year, whatever product is right for you. I get in touch with you to say, right, coming up, let's have a look. What's the best deal going? I'll get it sorted. Yeah. You know, whereas otherwise you have to do that. Or if you're with a bank, they're not necessarily going to do that for you. They'll send you a letter, absolutely, but you have to do the activities.
They're not
you have
quite
to do
as proactive as you would be.
Exactly. So because it's important to me, it's my business. I wanted to continue to grow and I want to help you, the clients, get the best deal possible.
I think it's important as well to let people know why we work together. So, I'm also a fully qualified mortgage advisor.
Yeah.
I've passed the regulated exams. I've got my license and such like. I choose not to do mortgages for a number of reasons. The main one being I simply don't do them often enough to maintain a knowledge of the market, the types of products that are out there, the rates that are out there. And we've known each other through our experiences coming through the academy with St. James's Place and gaining our qualifications in financial advice. And I reached out to you about a year ago, you would think. So I had a number of clients that were looking for mortgages and I was unable to help them at that stage. And we've got quite a good working relationship now where if I have a client who has any form of mortgage inquiry, I will field that to the best of my knowledge and then refer them on to you to take it to the next level. The plus side to that is you get a buy one, get one free. So not only are you getting an experienced qualified mortgage advisor like yourself, you're also on the back of that getting access to 2 fully qualified financial advisors.
Exactly. And it's streamlined because again, you can share the information because we're within the one company. They don't need to repeat themselves, but also I understand what their goals are, understand what they're wanting to do. We can have a joint approach in terms of being able to help them. If, you know, if it's for instance, a remortgage deal and they're wanting to be able to get a better deal so they can release funds because they want to start doing the savings strategy. I'll know that. You'll have shared that with me. So we'll know what the goals are for these clients. So having a joint approach makes a big difference for people, you know, and that's why I love it. And the reason I think I do mortgages, and I love mortgages is because I literally love that journey, being with the client and buying, especially when somebody's buying their first house. It's scary, like it's daunting, you know, it's the biggest purchase you'll make in your life and it matters so much. And I love being a part of that. And I think that really helps build client journeys, client relationships, and build trust and confidence. And I think if both of us are doing that together, you've got those clients who've had that hopefully great experience in going through that. But that's why I do well, I guess I do focus on mortgages. But yeah.
You said two words there that are imperative in the jobs that we do, and that's trust and confidence.
Yeah.
If you have trust and you're fully confident in the advisor that you're working with, you have absolutely no reason to worry about anything going wrong.
Yeah. And that is the thing. And but there are some amazing mortgage brokers out there, and there's probably not so great ones as well.
Absolutely.
And it's so important to get that person that you do know, like, and trust. I use that word all the time, because I genuinely care. I am as excited when a mortgage goes to offer, that's when you can legally sign to buy a property, because once you get a mortgage offer, that's the point when finances are in place, we can move forward. When I get the update that a mortgage offer comes in, like, I'm elated.
Yeah.
I can't wait to make the phone call to that client and go, we're in. It's great, and it makes such a big difference to people. And I think that's why it's probably why I'm so busy. Because that genuine care is it's really important.
Absolutely. And like you said, there's probably advisors out there who it's a lot more. It's less personal. It's more of sort of in and out.
Transactional.
Yeah. And there's not a lot of interaction once that first meeting has been done.
Yeah.
Whereas I know from experience, having dealt with mutual clients, that you're very much hands-on. You will take them from inquiry right through to picking up their keys, essentially. And
completely.
And even further on than that, looking at remortgages and maybe buying our second house or...
Yeah. I mean, from start to finish, what does a mortgage look like? So the first step is come see a mortgage broker, come see me straight away, because you want to have accurate figures. You want to know, what can I borrow?
Yeah.
How much will that cost per month? And what are all the options available to me? And you want to be able to go house hunting with the confidence of knowing that you can or cannot purchase the property, But that's the first step, getting good information so you can make informed decisions, Next step then is finding the property. And then the next step after that is getting the mortgage, okay? But we will have multiple meetings throughout all of this, and every stage is fully explained so that nothing should come as a surprise. I want my clients to know that from start to finish, nothing was a surprise. They knew what was going to happen at every stage. And I'm sometimes maybe a bit too thorough, but I think it's important just to be like that. And even when I'm explaining what the mortgage, because the terms and conditions can be a little bit dull, let's be real. Yeah. So, I make it as personable, as interesting as possible, so that people walk away feeling like they absolutely understand what they've done. When I'm speaking to somebody, I am watching their body language and like, did that land? And if it didn't, and if I think, even if they're nodding, because quite often you'll go, yeah, I got it. Like, no, you didn't. Let's go over that again. So I just want to make sure that it is completely understood, so that, you're taking out a mortgage, one of the biggest debts of your life. You want to make sure you've made all the right decisions, and I want to make sure you've done that too. So, but from start to finish, you will be aware of everything that needs to happen. And even when dealing with solicitors, again, I have some connections with great solicitors who do speak normal language, but some solicitors, well, it's not their fault. Legal language is a whole different language. It's not English, in my opinion.
It's definitely not an English language. It's very jargon based from experience, and can be quite daunting as well when you're not used to hearing that or seeing that language. It can be quite confusing. Yeah,
completely. And I always say to my clients, look, you're going to get, especially if you're doing a remortgage, there's some legal work involved. If you get the documents in, I'm so familiar with it, like I can run through it with you, and just, in actual English. So it can make a difference for people.
Excellent.
But so start to finish, and, and that makes a difference to people. And that's why people will come back then as well, for their remortgages, when their product's coming up for renewal, etc. But if you've not got a mortgage, you may not understand what that is all about, but we can explain that.
And I think it's important at the outset to make people realise that if you're meeting a mortgage advisor for the first time, and whether it's a remortgage or a home move or a first time buyer, there will be quite a lot of information and documentation that you're going to have to get to them initially.
Yeah.
But after that, the work that's involved from the client perspective it's not a lot of work. It's if you have a good broker.
Yeah.
Whereas I've had experience personally before I was in this job of dealing with a mortgage broker who didn't do anything after we met them. So I had to send the bank statements to the lender. I had to send the ID to the lender. I had to chase the solicitors. Whereas a good advisor that I know that you are will do all that for them as part of your service.
Like absolutely like nail on head. And I'm the same. I'm doing all of this because I had experienced the exact same thing. I wanted to provide a service that I wanted to experience myself, which I'm hoping I'm delivering. Well, I get good feedback, so I'd like to think that I am.
Every client I've referred to, I've also always had good feedback, which is always flattering. A positive.
So yeah, but again, it's comes down to caring enough. But yeah, so and I guess this is my own business as well. And I want it to work, and I want people to have to share their experiences. So it's important for me to do a good job for them and for me.
So Kenneth, there's a number of different types of lenders, borrowers, mortgage types out there. We're going to discuss a few of them in a little bit more detail just now. First time buyers.
Yep.
I would hate to be a first time buyer right now. It must be horrendous.
It is.
What are the common issues faced by first time buyers at present?
Few things. I mean, first thing I think everybody thinks of is deposit. Okay. So deposit size is a challenge for people, particularly those that have moved out of home, that are renting, because rent is high as well. So being able to save for a deposit, pay your rent, have a life, you're in the prime of your life. It's challenging, and Bank of Mum and Dad now is actually, I think, in the top 3 banks in the UK in terms of helping their children get a deposit, so that's probably the biggest challenge. Okay, so the other challenge is the smaller your deposit, the higher the mortgage companies will charge you interest, which I don't love that that's a fact, but it is, and that it's really painful. So you can get a mortgage with a 5% deposit now, and it's all about loan to value, LTV for short. You'll see that everywhere. So the higher your loan to value, which means if you've got a 5% deposit, you need a 95% mortgage. So that's a 95% LTV. 10% deposit, 90% LTV, 20% deposit, 80% LTV, etc., etc. The higher your LTV, the higher the interest rate you will get charged. Okay. So if you have a 95% mortgage, you will get charged the highest interest rate a bank's going to charge you. Okay. And not only that, the higher your loan to value, generally the higher the credit score is also expected from the applicant. So first time buyers in particular, they'll fall into sort of all of those categories. So you need to, if you want a high loan to value, you'll need to generally have very good credit score, and you will need to prepare to have to potentially have a bigger repayment cost. So that's the issues that are facing first time buyers. The pros, the positives out there is that there is 5% deposit. So you can get to a 5%, you can get a property. Okay. And if you're concerned about the monthly cost, we can stretch those repayment terms to start with to make it a bit more affordable, obviously to, within your planned retirement age, but certainly we can, there's up to 40-year mortgages now, which are helping people get on the property ladder, at an affordable monthly cost. Okay. So that's one way. There's government schemes to help people as well, first time buyers, which I'm very familiar with. There's the Help to Buy scheme. Scotland had the first time buyer, home scheme as well. It's gone now.
Yeah.
I can't remember. But
was it the first home fund or?
Yeah, that's it. First home fund,
something like
exactly.
that, yeah.
That's it. So, and that was really useful. So, and hopefully they'll continue to bring those things out. So again, having a mortgage broker who's up to date on all of these, because as well, like for instance, in the Scottish First Home Fund, there's only 11 borrowers that will give you a mortgage for a first home fund mortgage. So you need a mortgage broker who knows this.
I don't think that's common knowledge. I certainly didn't know that.
Ah, there you go now. You see, that's why you sent them over to me. So yes, you need to know who's going to lend to you. And it makes a big difference. But knowing that these support things are there it can be very useful, because there are companies, if you're using one of these schemes, that you don't even need to have a deposit. So there is the open market shared equity scheme, which is in Scotland.
It's a bit of a mouthful.
It is, yeah. Yeah. But it is, there are banks that will allow you to get a mortgage without a deposit, because the government is putting down a deposit for you up to 40% of the value of the property.
Okay.
Yeah. So these things are available, so come and speak to a mortgage broker, because there's solutions there. But again, make sure your credit score is good, be registered to vote at your address, etc., etc. If you're unsure about your credit score, there's ways to find out on free apps like Experian, for instance. Check your credit file, check that it's in order, and then have a conversation with a mortgage broker, me or Peter.
So the good news for first-time buyers is that there are options out there for them.
Absolutely.
Even if they don't have a deposit.
Yeah.
If they're actively looking to buy their first property, there are other options out there.
There certainly is. It's harder now than ever before, but there are solutions, and there is ways to get on the property ladder if you really want to.
So that's first-time buyers.
Yeah. There
are also remortgages.
Yes.
Which everyone who has a mortgage will be familiar with.
Yes.
You would think. But it's not just a straight remortgage some of the time. There's different options that come with it. You can change the term, you can borrow more. There's lots of different options when it comes to remortgaging. What are your experience of remortgaging? What are the most common reasons, other than a rate coming to an end, that people will want to remortgage the property?
Mm-hmm. Yeah. I think as well, some people think remortgage is you're remortgaging your house and you're getting more, you're releasing money, etc., etc. You're not. And for people who are not probably very familiar with mortgages, is to let them know your mortgage term, will say, is 25 years. Could be longer, could be shorter. But for an example, let's say it's 25 years. But you're not on an interest rate for the next 25 years. It's broken down into a number of years.
Yeah.
So let's say you've got a 2-year fixed rate. So you'll start your mortgage for 2 years and you'll be on this interest rate that will not change. And your monthly cost is going to be this much for the next 2 years. So when that comes to an end, you want to go on to another product, because if you let that finish and don't do anything, the banks will love you, because you will move on to the standard variable rate. Now, the standard variable rate is the most expensive rate you'll be on with a bank. So you do not want to sit on there unnecessarily.
Yeah.
You might want to if you're planning to move, if you're planning to sell, or because, it's very flexible. The standard variable rate doesn't have many rules. You can overpay, you can do whatever you want. So it's convenient if you've got plans to move, etc. But when your 2 years is coming up, or whatever length of time, but for this, we'll say 2 years. One, I will be in touch with you to say, right, a couple of months beforehand, let's have a look what is available. So your bank that you're with, or building society, they'll send you a letter and go, oh, if you stay with us, we'll give you this interest rate. Now, what sometimes happens is that banks or building societies may not be offering you the same kind of interest rates that attracted you in the first place. Yeah. So their loyalty products may not be as competitive as the original for new customers. So that's why the first thing I will do is check to see what the bank is offering, and then I will check the market. And if I see that the market is offering better rates, then I will advise, let's get this moved. Okay, because we're going to save you money. And that's what we want to do. So that's what a remortgage is. It's coming to the end of a product rate. Okay. And then at that time as well, again, and this is why having the relationship, I'll know, for instance, say that person was a first-time buyer originally.
Yeah.
They've come to the end of the 2-year. We maybe started on a longer term, say 40 years, but they would like it to be shorter. So at that 2 years, it's me then saying, right, okay, we're now at a 38-year term. Shall we look at what 35 years looks like? Because most likely people will have had promotions, their earnings have increased, but also they're more familiar with the household costs. So they now know, actually, yeah, we can afford to do that. We can bring this down, continue paying the same, but actually reduce the term.
Yeah.
Great.
Sometimes the loan to value could have changed quite significantly in that 2-year period, which means you could drop down into the next interest rate bracket. So you could potentially be paying the same that you're already paying, but shaving 2 or 3, maybe even 4 or 5 years off your mortgage term.
Absolutely. And how your loan to value changes is because over the past 2 years, you've been making repayments, which is great. So you've reduced the amount that you originally borrowed, and hopefully your property has gone up in value. So with those 2 changes, you can get access then to a better loan to value, and which, like I said earlier, gets you access to better interest rates, depending on what interest rates are available at the time, because interest rates go up and down. Okay. But absolutely, that's a dream, is that you're able to get onto, a better interest rate. So if you get a 95% loan to value, then potentially 2 years later, you'll be able to get 90% or maybe 85% LTV. So that's really beneficial. And working with you then as well, you'll have had conversations with your clients, having their financial plans. You can go, Kenneth, their mortgage is coming up. They would like to have a lower monthly cost because they want to do an extra £200 a month savings plans because they've got children starting school and they've got something in the future they want to have money for. They still want to reduce their mortgage, absolutely, which is what I would do, but we'd be aiming to release some of that money that they would have been paying for that mortgage, get that into a savings plan, and their financial goals are being met then as well, which is why the joint up approach makes
a lot of sense.
Yeah. So yeah, that's remortgage. And the most important thing is go to your broker, find out what's coming up at the end of your term. Don't just let it roll over, because you've got choices, and we can make a big difference by giving advice, and it makes it really worthwhile. And like I said, if the best place turns out to be where you're at, we'll keep it there. So yeah, it's worth checking it out.
Buy-to-lets, Kenneth.
Yeah.
Massive issue in the market just now. Everybody seems to want a buy-to-let. What are the main obstacles for people when it comes to buying a property to rent out?
There's a few things you need to, I think, understand and be aware of is the most important thing. And yeah, buy-to-lets are becoming very popular, and the government are aware of that now as well. So they have changed the tax rules on it. So before, they were a lot more tax efficient. Yeah. But you can see whenever the government wants to change something, they will just, put in a tax, whatever, make pensions really tax efficient, because they really want people to be investing in their private pensions, and they're making buy-to-let properties less tax efficient. So, which is why it's good to have a really balanced approach, and having a financial advisor that will, help, because buy-to-let properties they are lucrative if done the right way, and they can be tax efficient, but again, in a balanced portfolio and a good financial plan, because you don't want all your eggs in one basket, because bear in mind, property goes up and down in value as well. Okay. So it's really important to have a balanced approach, but things to be mindful of are, first of all, is the second home tax, which is called Additional Dwelling Supplement, ADS, in Scotland. That's 4% of the purchase price.
Which can be, if you're buying in Edinburgh especially, can be quite a lot of money. Absolutely.
And where it can really have an impact on people is if somebody lives in their current first home flat in Edinburgh, lovely, and they think, right, let's get a bigger home, but let's keep this property we've got.
Yeah. But
what they're doing is they're buying their main residence. Your main residence normally will be more expensive than your buy-to-let properties. Okay. But if you hold on to that property to try to buy your main residence, you have to pay 4% on your main residence. And you also have to pay stamp duty, which is called Land and Building Transaction Tax in Scotland, LBTT. So you have the LBTT bill, and you will have the additional dwelling supplement bill on your new purchase. Mm-hmm. So you have to really weigh up if it's going to be beneficial to hold on to that property rather than sell it, buy your main residence, and then buy a buy-to-let after. That can reduce the cost significantly. So, and I do that calculation with all of my clients who are thinking about doing that, because that's quite often, people.
It's quite a popular option for people, like you said, who have maybe bought their flats on their own. They're now in a relationship. They're thinking about buying their first property with their partner.
Yeah.
They've got these 2 flats. Mm-hmm. What do we do with them?
Yeah.
Do we sell them? Do we remortgage them to get the deposit? Do we put them on buy-to-lets to get the income? It can be quite a lot to take in, and it can be quite a big decision to make.
Absolutely. And sometimes, it's more cost effective to hold on because it depends on the purchase price of the place you're going, but also it depends on, like, if you have to sell a property, the estate agency costs, the legal costs, etc., etc. So they can stack up as well. Mm-hmm. So the circumstances can be different for everyone. So that's definitely one thing to be mindful of when you're planning to do it, because it's better to pay the 4% on a buy-to-let property rather than your main residence. But if you are in a position that happens, you say, you find somewhere you love and you need to move fast, getting this onto a buy-to-let and just moving in, that can be the best option. Yeah. If you sell that property where you were before, that you had up for let or whatnot, if you sell it within 18 months, you will get back the additional dwelling supplement that you paid. Okay. So that's something to be mindful of. That might be a good solution for people. Okay. So yeah, it used to be 3 years, but that's coming down because, again, the government don't love it. So that's coming down and down, but 18 months at least. You've got a year and a half to sell. If you're struggling to sell, and you really want to buy this new place, then you can do that as well. But you need to have that cash to hand, so you need to pay the bill before you can buy the house. So
you've mentioned there the additional dwelling supplement.
Yep.
And the LBTT.
Yep.
Which they are effectively tax on property purchases.
It is, yeah.
They might have slightly different, fancier names, but it's effectively a tax on purchased property. What people sometimes don't realise when they're buying a property to let out is the additional taxation that comes with it after you've got a tenant. Income tax, for example. Yeah. You have to pay income tax on that income. You have to do a self-assessment and declare that income, which for someone who maybe they're not working, they don't have an income, it's not really that big an issue. But if you're an employed person and you have a buy-to-let property, that can sometimes be the difference between being a basic rate taxpayer and a higher rate taxpayer. Yeah. Which can also factor in to your decision on whether or not to have a buy-to-let property.
Absolutely. And getting advice, I think particularly for buy-to-lets, is just so important. And as well, you need to be mindful if you are speaking to a mortgage broker. So I'm a fully qualified financial advisor. I have a qualification in taxation, much like yourself. So in areas like buy-to-lets, I can go beyond a mortgage, and having the knowledge like income tax and the implications is really important. Because again, about 4 years ago, you could take off the interest of a mortgage off the rent that you've received before you pay tax. But now you can't, which is a significant difference in terms of how much tax you need to pay. So for some people, it's not adding up for them. They're not making money out of these because they're now having to pay a lot more tax from the income that's being received. If that person is a higher rate taxpayer, all that rental income is going to be receiving 41% tax in Scotland. So you need to really know your numbers if you're planning to do a buy-to-let. And income tax is one thing. We've got the property tax, we've got the income tax, then we've got capital gains tax. Yeah. So again, it's understanding, why are you buying this buy-to-let? Is this for life or is this for 10 years? Yep. What is the long-term plan? Because if you're going to sell that property in the future, if that's what you want to do. You may.
Most people will do at some point.
Yeah, potentially. Then you will have to pay capital gains tax on the growth that you have received. Again, if you are a higher rate taxpayer, when that happens, that's 28% at present. All tax rates can change, as you know. 28% of the growth on that property will go to tax. So you'll have paid your additional dwelling supplement, you'll have paid your LBTT, you'll be paying income tax, and then you'll have capital gains tax. Is this the best investment for you? We can calculate it and we can let you know, absolutely. But you have to be very mindful that all of these are going to be considered.
And you're absolutely correct in what you said there. It has to be right for you as an individual. It has to be something that you need to fully understand before you jump in with 2 feet.
Yeah.
Too many times have I seen someone who's just bought a buy-to-let property off their own back. They've went to a bank and said, I want a buy-to-let mortgage. Here's my deposit. And they don't know what they're getting themselves into.
Absolutely.
Like you said, you've got income, you've got land and buildings transaction tax, you've got ADS, the additional dwelling supplement, you've got the income tax that you potentially have to pay on the income. And then when you come to sell it, you've got the capital gains tax. And yes, there are ways that you can help reduce those liabilities, which again, as we're having a fully qualified financial advisor to hand helps. You can reduce those liabilities legally through time.
Exactly.
But the chances of you not having to pay any of them are really slim.
Exactly. But you can plan it, you see. It makes a big difference. So for a buy-to-let, for instance, say you've got husband and wife. Wife, higher rate taxpayer, earns a lot. Husband has been a homemaker, hasn't done anything. Okay. So what you might want to do in that situation is have the wife own 10% of the buy-to-let and have the husband own 90% of the buy-to-let. That way, only 10% of the income can go on the, you can do it 1% to 99% if you like, but if they're buying it jointly, you'll have to both be on it. But then only a very small amount of the rental income will need to obviously have higher rate tax. And the majority of the rental income could be through the husband, and very tax efficient way of doing it. So those kind of ideas make a big difference, You also have a choice. You can purchase it personally in your own name, or you can purchase it through a company. If you purchase it through a company, and again, by the way, setting up a limited company sounds daunting. You're like, how do I even start?
It's extremely easy. I've recently done it. It's a very easy process. You fill in a couple of forms, you register the name. I think it costs you £12. It's not a difficult process, but it's a decision that you would need to make.
Calculate.
Yeah, you need to make an informed decision and be 100% certain that that's the right option.
Yeah, because there are more tax efficient options through it. But again, what is the long-term goal? Because if you want, if you're using this for a pension fund, you want to get an income in retirement. If you have that property in a company, that rental income, even while you're in retirement, will have to pay corporation tax. So are you going to actually save, if you only own one property, for the length of time you're going to be retired, paying corporation tax that whole time of the rental income? Or are you better off to actually own it individually, and at retirement, you don't have any tax to pay? So those calculations make a difference to people, and understanding it makes a difference to people. And that's what you want to do. One other thing on the buy-to-let I'm going to add, which can be very tax efficient, is actually, but you may not want to do this, but holiday lets are very tax efficient. And you can even use Airbnb for a holiday let, and owning it as a holiday let. There are rules that you have to understand that the government have put on holiday lets, and understanding them again, because you can only use it personally for so long during the year, etc. But there is a lot more tax efficient breaks in it. So that's a good thing to know. But again, and much like buy-to-let properties, holiday lets, obviously that has a lot more intense time and energy that you need to put into it, etc. Do you want to do that? But buy-to-let properties, it's not a walk in the park either. That it's a job. It has to be managed. You have to, get the right tenants in. There can be turnover. There can be times when you don't have tenants that you need to pay the bills. So consideration is really important. And talking it out rather than going straight in.
Yeah.
Make sure that you know what you're doing. You're prepared for what has to come ahead, and then you'll be happy with your decision. Then once you've talked.
Make sure you fully understand it before you jump in with 2 feet and then have to start scrambling to understand it.
But it can be very lucrative, and it can make a very big difference to somebody because you can invest. Oh, I should add, if you want to get a buy-to-let property, you will need, at the moment, 25% deposit. Before coronavirus, 20%, you could get an 80% LTV, but at the moment, 25% is pretty much the going deposit size. So it's a big enough deposit as well that is required for buy-to-let. But if you think of the returns, and if somebody else is repaying your mortgage, etc., it can be, it can be a good return for what you're investing. So yeah, but again, it's all part of a balanced, smart financial plan.
And just one final thing on buy-to-lets before we move on.
Yeah.
Getting the first one is the hardest.
Yeah.
Once you've got the first one, if you're in the mindset that you want a portfolio of buy-to-let properties, the first one is the hardest one.
Yeah.
Once you've got that, you can take equity from it to buy the next one, and then continue that until you've got enough that you've reached your limit.
Yeah. If somebody tells me their plan, what they want, then I will find the mortgage that's right for them. Because if somebody comes to me and says, just want one property, I don't want too much fuss, I don't want the idea of having to manage all these things, the solution I create for them will be much different to the person that comes and said, my goal is I want 2, 3, whatever, in the next few years. How are you going to make that happen, Kenneth? And I'm like, right, this is what I think you should do. Because buy-to-let properties, the repayment strategy is different to a main residence because it's a second home.
Yeah.
It's a business, essentially. So there's a lot of different rules, and there's a lot of mechanisms you can do to make them as profitable as possible, and to help that person, do what they want to do in terms of get more and more, because you can use as much of the rental income as possible to do that. So, but yeah, there's ways to make that happen, which it's fun to be part of the journey too. You watch people grow their portfolio and you think, right, I've been a part of this, making it happen. And
we can help them through the entire journey. So we're not just there for the mortgages as well. We're there to then help them offload those properties tax efficiently.
Yeah. As
you alluded to earlier, with capital gains tax, we can put a plan in place, and they say, well, I want to keep these until retirement age, and I want to start offloading them. Then that's something that we can work towards as the years go past.
Yeah. Particularly because if somebody is wanting a buy-to-let portfolio, it might be the right thing for them to do it through a company. Okay. And then company directors. So you can't necessarily use rental income. Actually, you can't use rental income as earnings to put in a pension if you're a person. But if you're a company director, a director can use income from the company to go into a pension, which yourself, you get reduced corporation tax. It's very tax efficient. Planning wise, to get money out of the company using the pension as well. All very tax efficient and perfectly legal and acceptable ways to manage your finances. So again, all of that strategy in terms of getting the right plan for you makes a big difference. And starting that before you buy the properties is important too. If you have lots of buy-to-let properties in your personal name already, and then you're thinking, oh, it'd be so much more tax efficient to have them in a company. It's not difficult. It's actually pretty easy. It's just, it'll cost you a lot if you then want to move them into a company, because your company has to buy them from you. So you have to sell them to the company. The company has to pay additional dwelling supplement on all of them. And you will have to pay capital gains tax on all of them for selling them. So it quite often is not cost effective to move personal purchased buy-to-let properties into a company. So you kind of need to know what your plan is at the start and go from there.
One other huge area at the moment, and I've seen a lot of it recently, I got a lot of questions about it, is people who are self-employed, so sole traders, partnerships, and also people who own their own limited companies. So, and how do these people get mortgages? There seems to be a real common misconception at the moment that you have to have a minimum of 3 years accounts before anyone will even consider giving you a mortgage. I know from personal experience that that's not the case. But what are the sort of main obstacles that these people face in getting a mortgage, and how much evidence of income do you actually need to be able to get these types of people a mortgage?
Mm-hmm. Self-employed people, if you are self-employed or a company director, etc., I definitely think that it is worthwhile speaking to a mortgage broker, because you will get, proper advice. But in general, if you've got 2 years accounts, that's pretty much a win. Most lenders will lend on that. Okay. So when I say 2 years accounts, if you've got 2 years SA 302s, SA is for HMRC. SA stands for self-assessment. 302 is just a number of the form. Okay. So if you've got your SA 302s and a tax year overview for 2 years, you'll pretty much get a mortgage. Okay. So SA 302 is your tax calculation. It shows as a person, how much have I earned and how much tax did I need to pay? Your tax year overview, that is pretty much your receipt from the HMRC saying, I've paid my tax. So the mortgage providers want to see how much have you earned, how much tax did you need to pay, and have you paid it, essentially. Yeah. Okay. So if you've got 2 years of that, great. Okay. If you have only one, there are still options. Less options.
I was in that exact same position.
Yeah. So it can still be done.
Yeah.
Absolutely. Because at the end of the day, if you are able to demonstrate to a mortgage company that you've got a successful business, you've been in the industry for X number of years, etc., they want to lend to you.
And I think that's a big thing. If you jump into an industry that you're unfamiliar with, that's something that a mortgage provider, that's a red flag to them.
Yeah.
But if you have been a joiner, for example, for 10 years and suddenly decide you're going to go self-employed, having a year's worth of income is more than likely going to be enough if you can evidence your experience within the industry.
Absolutely. And, a lot of banks and building societies, they've turned a corner nowadays. Common sense, is becoming a factor in cases, and they're beginning to be, a little bit more flexible. Just, does this case make sense? And if it does, you'll probably be able to find a lender that will lend to you. So, so never feel like, oh, I've only got 1 year's accounts, or maybe, it's not looking good or whatever, but just come and speak to somebody. So I do think people get turned off a little bit when they go self-employed. They don't really know what it's going to do. But if you've got those 2 SA 302s and tax year overviews, you're in. That's fine. What else was there?
Is that the same for limited company directors as well?
Oh, okay. Actually, I'm glad you asked that, because so when you're a company director, you are obviously paying corporation tax for the income your business is growing. And if you release funds, which is to pay yourself a salary, to pay yourself dividends, etc., you only need so much, because you have to withdraw any money out of your company, it'll be taxed. Okay. Yeah. So if you don't need to pay yourself 40 grand a year, you can live off of 30 grand a year, then there's going to be money sitting in your company that you're not withdrawing, because you're not going to withdraw it unnecessarily and pay tax to withdraw it. So what's the point? But you might feel, oh, but my income is only going to be 30 grand a year. If I want to get a mortgage, if I want to get anything, it's going to be less. So there are many companies that will use retained profit within a company. So if you can evidence, look, my company is very successful. I'm growing and growing and growing, but I don't need this amount of income. Yeah. So I don't release it from the company. So there are mortgage companies that will use that retained profit as part of your income to let you borrow what you need. So it's good to know that as well.
Yeah, definitely. And I don't think a lot of people probably do know that.
Yeah. And potentially some people have went into their branch where their bank is, and their branch don't do that. So you need to speak to a mortgage broker, so a mortgage broker knows which companies do lend like that. And there are high street banks that do that. It's not like, you need to go to a specialist lender. But again, it's going back to that. All banks and building societies have different criteria. Okay. So, and that's the big difference in terms of going to a broker as opposed to that one person in a branch, because they can only talk about that company's criteria. And I mean, there's like 100 banks and building societies that we can use in the UK. So there is such variety. So yeah, that's pretty good for companies in terms of self-employment.
So I done a story on my Instagram yesterday, just asking my followers if they had any mortgage or property related questions that they wanted answered, just to drop me in a DM. And I had quite a few responses. So I picked what I thought would be the top 5.
Okay.
And hopefully you'll be able to give us some informative answers.
Good. I'm sure we will.
I won't name names because I'm not sure if these people will want me to do that.
That's fine.
So we'll keep it anonymous. I'm going to go with this one first because I think this is quite important. How much do you charge for your services?
I'm glad you started with that, actually, because I have my own business, and it is so important to me to have my morals, values, principles at all times. Okay. So when somebody wants to get mortgage advice from me, I do not charge a broker fee. And the reason I do that is because I think when somebody is buying the biggest purchase of their life, I think everyone should have access to advice. And so I want to make sure that everybody is priced in. I don't do it for free. So I get paid by the mortgage providers. So every mortgage broker in the UK receive payment from the mortgage company for advising them to take the mortgage there. Okay. That is enough payment for me to be able to allow people to get advice. So, and that's something that's really important to me. Things might change in the future if mortgage companies stop paying what is called the procuration fee, etc. But while they do, I will maintain that I don't charge a broker fee. And I feel pretty proud about that because I want everybody to be able to know that they are making informed decisions and doing the right thing for the biggest purchase of their life. So yeah.
Question number 2.
Yes.
I don't know how much you'll be able to help on this one. I might be able to jump in because I've got a little bit of expertise in this area. So this particular gentleman has a buy-to-let portfolio of around 5 properties. Mm-hmm. He's currently managing it all on his own. Would you recommend exploring the possibility of using a letting agent?
Oh, you know what? That's kind of hard to answer. I think some people think our job is really easy and we can just advise immediately having no background or context. But it depends on the person, doesn't it? Is that person full-time employed? Is that person married? Do they have children? How much time can they give? So it's very different answer for different circumstances. So property management companies are great for what they do. They'll do the background search, they'll do the credit score, they'll keep the maintenance up, etc. They do great amounts of work, but they charge for that, so it'll range from 8 to 12%, if not a little bit more. So it's a cost, tax deductible, yes, but it's still a cost every month that you will face. But you might feel that cost is worth it if you are full-time employed and you have family and you've got things you want to do. You might have elderly, sick parents, etc. So it's understanding the background. Yeah.
And I think you need, like you said, if you've got a steady tenant in there and they've been there for a long time and they don't cause you any problems, having a buy-to-let property and manage it on your own is easy.
Yeah.
But there will be times where you maybe, if you've, like this guy, if you've got 5, all the tenants might leave at the same time.
Yeah.
You then have to find 5 new tenants. You then have to you have to background check 5 new tenants. You have to do credit searches. You have to do everything that comes along with that. There's maintenance. You'll have to do inventory for every single one.
Yeah.
It can be quite time consuming. And like I said, it can be a full-time job.
It is a full-time job for many people. Absolutely. And as well, there's different types of properties. So if all of those 5 properties were 1-bedroom flats, maybe easy enough to manage, with maybe a couple or a single person living there. If you've got a HMO, which is a house of multiple occupancy, you're renting per room. So you'll have a contract with the individual per room. So, that's maintenance. That it is time consuming. But again, if this is your job, great. It's fine. And you'll save yourself costs without a doubt. But if you've got concerns over your own personal time, then, without a doubt, there are some fantastic property management companies. And there's some I recommend as well. So, yeah.
The next question is kind of following a trend here. It's another buy-to-let question.
Mm-hmm. Mm.
So this particular person is planning on purchasing a buy-to-let. They haven't said when. I'm assuming it's probably going to be quite soon. It will be to supplement their income.
Mm-hmm.
What type of mortgage would suit them best?
Again, I would have to understand their background. I need to know, do they work? What is their plan? Do they want more buy-to-let portfolios, etc.? But I guess one thing to remember is, I think I said this earlier actually, but when you're getting a buy-to-let, it's seen as a business. It's seen as a second home. It is not the same conditions as your main residence. So if you've got a buy-to-let, or if you've got a main residence mortgage, your mortgage generally needs to be completed before your planned retirement age. Whereas for a buy-to-let, it doesn't. So because with a buy-to-let, you can get an interest-only mortgage or you can get a repayment mortgage, okay? Interest-only mortgage will allow you to use more of the rental income because you're not actually reducing the borrowing. So the cost of your mortgage is going to be significantly less.
Yep.
So some people who potentially have maybe a 5 to 10 year plan of having more buy-to-let properties, they want to get the maximum amount out of their rental income. So they'll use interest-only mortgages. They will obviously pay the tax and whatever, but they'll let that fund accumulate. They'll have an account where all the rent goes in, bills go out, and that'll accumulate for the next 2 years, probably on a 2-year fixed. What they'll do when the mortgage comes up for renewal is they will release the equity that has grown in the value of the property. So if they put down a 25% deposit at the time on a 75% loan to value, they will remortgage back to 75% loan to value. They'll release the equity that the property has grown. They'll use the rental accrued rent that they've in the 2 years, and then they've got a new deposit for another property. That might take a bit longer. It all depends on where your property is and what the rental values are, etc. But that's quite often how people will build up the portfolio. So it's really interesting. But there's other people that don't want that. They don't want a portfolio. They don't want the hassle, but they would like one property that they'll have in their retirement. They're happy to manage, and they don't want a mortgage at the end of the term. They want it to be repaid, but they would like the cost to be as less as possible. So for them, we could stretch the term for 40 years. So while that might go way past their retirement, they know that their mortgage is gradually decreasing and that they feel better about that. And as well, they'll get access to lower LTVs in the future as well because they're reducing the borrowing and the property is going up. So they feel better about that and knowing at least at some point, they won't have a mortgage. Others want to pay it off as soon as possible. They don't even want to earn money from it. Yeah. But that question was about how do I get the most out of the rental income? And that's the options of interest only or really stretching the term.
Perfect.
Sorry, that was like a 1 minute question for 5 minutes.
That's okay. That's a lot of information, which is good.
Yeah, but buy-to-lets, there's so many options, you see. So, and it's always a really interesting subject. And as well, if you do choose to come and speak to me or us, I have a buy-to-let property. I understand. I have experience. I know. Yeah. Not only do I know about the mortgages, I actually can talk from first-hand experience as well. So it's good to have that knowledge as well, bearing in mind when I'm giving advice.
And just going back to the previous question about letting agents, I used to manage a property on my own. I've passed it to a letting agent so I can kind of see both sides of that coin.
Absolutely. Yeah. Because it's personal.
Absolutely. Different for everybody. Question 4.
Yep.
This is probably one that you have had quite a bit. I know it's one that tends to come up quite a lot. I've had previous bad credit, which I've been recovering from for around 18 months. Can I get a mortgage or do I need to wait 5 years?
I mean, it very much depends again, okay? But if you've got bad credit, it is all right. It's all right. There are companies that will lend, okay? It depends on how bad it is, okay? But certainly on your credit file, you'll probably know there's defaults.
Yep.
So some companies, if you've had a default within the past 6 months, won't lend to you. Some companies, they will. So the companies that will charge you more. Okay, so as long as you are prepared to probably pay more than what the market would be willing to charge you for a mortgage, then yeah, you probably can, but just depending on your circumstances. Speak to a mortgage broker and find out, because it will depend on the impact that's been made on the credit score.
And last one, there's a lot of chat about the Bank of England base rate. Obviously, inflation has gone through the roof over the last few months with everybody coming out of lockdown and everybody spending again, and there's talk of the base rate going up slightly. What are your opinions of how quickly the Bank of England base rate will go up, and is it worthwhile people fixing their mortgage for a longer term, so 5 years, 10 years?
Yeah. I mean,
that's probably not fair of me to ask you to look into a crystal ball. No one knows what the Bank of England base rate is going to do, but it's as low as it's ever been, and it's probably as low as it will ever get.
Yeah.
Is it worth someone who's maybe buying a house or remortgaging, fixing their rate for a longer period of time to tie in that lower rate, knowing that it's only really going to go one way?
Yeah. I mean, researchers, forecasters, etc., are not predicting huge Bank of England base rate rises, but we could all be wrong. You know what I mean? But we're not predicting, like Thatcher years, 13% mortgage charges. Like, we're not predicting that that's going to happen, but we will potentially see it go up. I mean, the Bank of England base rate is the lowest it's been in history, and inflation is creeping up, but their target is 2%. Okay. So if you average it out, inflation, it could go up to like 3%, and go back down a bit, because it fluctuates. So as long as it's averaging out at the 2%, if it hits 3, that's kind of all right. It's not the biggest deal. So it's not necessarily going to change straight away. And we've come out of a recession, or we're in a recession after coronavirus, so they're going to be very cautious on changing the Bank of England base rate, really cautious, because it has a very large impact on the economy. But that being said, the Bank of England base rate is the lowest it's been in history, which is great for borrowers. Okay. So again, it comes down to the loan to value, the LTV, like I mentioned earlier. If you have a 95% LTV, you're going to be getting charged the highest rate available. Yeah. Do you want to fix that for 5 years? I don't know. You may want to. You may feel like, I prefer the sturdiness of knowing that this is my cost for the next 5 years. Fine. But if you have a loan to value of 75% and you can get a fixed rate for 5 years, that might be a good opportunistic time to get a low rate, because at 75% LTV, you'll be getting good products. You'll be able to get a good rate. And if you can fix it for 5 years, great. Yeah, absolutely. I certainly would encourage it. But again, I would encourage it when I understand your background. Do you plan to move? Will you need to release equity from this property? Do you want, will you be going overseas? Will you, anything can happen. 5 years is a long time. You can get 10-year fixed rates, but just what is your plan? Excuse me. Understanding that if you think you are in your forever home, and you've no intentions of moving, you're in a strong, solid relationship that's not going to end up in divorce, or, not that you ever know. It's like, well, I think we'll all just agree to that we are. So, it's not knowing what's going to happen in the future, but those kind of things, can have it. It's like, if you did have a separation, you would then face potentially an early repayment charge on the fixed rate. And if you've got a 10-year fixed rate, that is exceptionally high. Yeah. Even a 5-year fixed rate, the early repayment charge in the first year is very high if you want to come out of it. So you want to make sure you're in it for the long haul. And if you are, there is definitely some great rates out there that can be worthwhile fixing into.
Great. That's a great answer, Kenneth. Thanks very much for that. That's us out of time, unfortunately. We've covered quite a lot today.
We have.
I really appreciate you coming on. It's been really informative. I've learnt a few things.
Good.
I hope everybody watching and listening has learnt quite a lot. If you have any other questions after watching or listening, I'll pop the links to the social media pages and websites underneath in the comments, and feel free to touch base with either of us, and we'll do our best to answer any questions that you have. But Kenneth, again, thanks very much for coming on. I really appreciate it, and hopefully we'll have you on again soon.
Thank you very much. I enjoyed it. Yeah, hopefully I'll see you soon.